All right, let's talk about gold and the role it has in your portfolio. So, one of the questions that I often think about and get asked is, should you invest in gold? I have a family member who had talked to me recently about going out to buy gold, and she was really meaning that she would go down to a coin shop and either buy gold coins or gold bullions and keep that somewhere as an investment. And for the longest time, I didn't really have a good answer to her except to say that that's not really safe, it's risky, it's cumbersome and all of that. But this question has come up quite a bit recently, and more recently as I started to build out my long-term asset allocation. So I want to talk a little bit about gold as an investment and whether or not you should have it in your portfolio. So the first thing to say about gold is that in my opinion, gold is really not an investment. And when I say this, a lot of gold bugs are going to come out and say, what the hell are you talking about? Of course it is. But in reality, it really isn't when you think about what makes something an investment. And basically, an investment is something that's not speculative and is something that's going to return you a real rate of return over the long term for taking on some kind of risk, right? It's a income producing, cash flow producing asset. And as such, gold doesn't do that. It doesn't produce any cash flow at all. It just kind of sits there. The one thing that gold does have going for it is that it is a store of value. We can debate how good it is as a store of value. And it is somewhat a hedge against inflation over the very long term. But again, probably not the greatest hedge of inflation that you can get. So bottom line, what do I think about gold as a investment? I don't think it really is, but as part of a larger portfolio, I do think that it has a place. And the reason for that is that in small amounts, the volatility of gold in the short term, it'll go all over the place in terms of prices. And in times when there is a perceived crisis or a real crisis, even if inflation is relatively stable, gold can fluctuate wildly. When there is actual inflation, God only knows what gold will do. But the point of having a little bit of gold in your portfolio is that it's so uncorrelated with other assets that as part of a larger portfolio, you're rebalancing every year, you can use that fluctuation to actually reduce the risk of the portfolio as a whole. So while gold itself is very volatile and jumps around all the time, when you put it into a portfolio, it is actually very helpful to the portfolio overall. So let's go ahead and take a look at the computer and see what we're talking about in terms of real returns. So I have up here the historical returns of gold. And this is looking at it from 1972 until the end of 2020. And the nominal return for gold is about 7.9%. Now, you hear 7.9%, you're telling me, well, what the hell are you talking about? It has a real return. Well, when you look at it compared to inflation, that drops down to about 3.9%. So this is decidedly, less than stocks. And over that same time period, you're going to get a lot of fluctuation. If we were to go to, like Portfolio Visualizer and just do a backtest allocation of just gold, put in 100% of portfolio, and analyze it, we'll see that that compounded CAGR, this is going out to July of 21, so instead of 2020, it's a little bit more, but it's still matching because you can see that the CAGR is 7.66, whereas this side is saying it's 7.86. If I were to make this just 2020, I'm willing to bet that it's going to be about the same. So when we look at this, yeah, 7.86, right? So again, this is nominal, this is before inflation. But it does fluctuate wildly, and by itself, it can have a max drawdown that's even worse than stocks, right, at 62%. And the standard deviation is just crazy. When we compare that to something like US stock market, we can clearly see that the rate of return on stocks is a whole 3 points higher. The standard deviation is actually less for stocks, but stocks by themselves also have a dramatic drawdown at times, right? So what typically people would do is build something like a stock bond portfolio, And the classic one would be something like a 60-40 portfolio. So I'm going to go ahead and just put in US stock market here. So fixed income, total US bond market, and we'll do 60-40. And we'll analyze this. Now the time frame has dropped from 1972 to 2020 down to 1987 to 2020. But again, it's long enough for us to evaluate. So when you see that you're adding bonds to the portfolio, your return, yes, drops. But it's still much higher than gold for this time period anyways. And more importantly, your max drawdown has gone down significantly. Okay? So what would happen if we were to reduce, let's just say that we take off 10% of our stocks. Actually, I'm going to take off 5% of the stocks, 10% in the bonds, and put that 15 back in gold. Okay? And we'll compare that to the 60-40 that we had before. And we can see the effects of gold on the portfolio. So what happens is that when we add gold to the portfolio here, this is portfolio 3, and it's just a little bit, your compounded annual growth rate, the CAGR, is just very slightly below the 60-40 portfolio. So 9.1 versus 8.8. But your max drawdown has dropped quite a bit. And you can play around with gold in your portfolio and see what's the optimal. But a little bit of gold does help with volatility as long as you're putting it in a bigger portfolio and you're rebalancing year after year. The other thing to think about when you're looking at gold and evaluating it is that in 1972, the US cut off the dollar, the value of the dollar being pegged to gold. So it's always helpful when you're looking at gold return to look from about 1972 onwards, because when you look at gold returns before that, it doesn't make a whole lot of sense. So the bottom line for me is that gold itself is not an individual standalone investment that I think you should put a significant amount of money towards. It does have its uses, and as part of a larger portfolio, that volatility in gold can be very helpful. What I would say is that normally I would not put more than maybe 5 to 10% of my own portfolio into gold, except for times when I'm thinking that there's a lot of inflation ahead of us. So I feel that way now. Do I have a crystal ball and do I know for sure? I don't. But my thinking is that we have a higher chance of inflation going forward than we would normally. And as such, I feel confident, or I shouldn't say confident, I feel comfortable allocating up to 15% of my portfolio into gold, whereas I normally wouldn't do that otherwise. All right, I hope that answers your question about what the role of gold should be in your portfolio. If you liked the video and found it useful, please give me a thumbs up and come back and check for more updates in the future. Thanks. Later.